In this video, I am going to provide a recap of what we had discussed during our call last week. And really what I'll go over is the best way to pay for the new home that you're building. And we'll look at two options. Option A, we'll look at paying for the new home with your policy. And then option B, we'll look at paying for the new home just with pure cash. So I know per our conversation last week, your current plan is to pay for the home as the builder takes on more costs. So if you've got 3 or 4 installments that you'll pay by 2025 when you get into the home, that is the plan, which eliminates the need to have to work with a bank or lending institution, which makes life very easy. So I did consider that in both options. I'll go through both options in detail right now, and then we'll look at some numbers. So option A, what we've got here is first funding the policy with the maximum amount and starting to do this immediately. So here you're going to see funding the policy aggressively for the next several years. And while you are funding the policy aggressively, you're taking the money out through policy loans and using that money to pay for the new home. So here, money goes in, it comes right back out in the form of a loan to pay for the home. Once the home is paid for, what we'll then do is reduce the policy funding just to the minimum premium. And the reason why is because we'll take the cash flow that was going toward the policy, toward premium and PUA payments, and redirect that toward the policy loan. This way, we've got that wiped out altogether. And then after the policy loan is repaid, you can resume funding the policy at the maximum amount again. I did that through policy year 10, just because that's what we looked at during our call last week. So the advantage to this scenario is by getting money into the policy, it's forever compounding for you. So once a dollar flows through the cash value, even when you borrow against that policy, you're still earning interest on all of the money that you've paid into the policy. So it's forever compounding. That's the advantage. The disadvantage to this scenario is you've got the loan interest that's also due. So we've got to make sure we consider that when we look at the comparison of the two options. Then we've got option B. So option B, this involves funding your policy with just the minimum. So what we'll do immediately is scale the funding down just to the minimum premium only. We'll assume you're adding nothing extra into the policy. And what you're doing is taking cash flow that normally you would fund the policy with and paying for your home in cash. And then once the home is paid for, then we'll look to fund the policy at the maximum dollar amount again. A nice part about this option from a simplicity standpoint is that there's no policy loans at all. It's very, very easy. Literally, all you're doing is taking money and just buying the home. So it's very straightforward. It's a cash purchase. So you do eliminate a step with the policy loans here. Not that policy loans are difficult. They're very easy. I know you've been using your policy, so you've got experience there. But you do eliminate a step. And then really what I aimed for here is to keep the out-of-pocket cash flow exactly the same. So when we compare option A and option B, as far as what you're paying into the policy is identical. And why we want to do that is because at the end of this plan, we want to see which option gives you more money. This way you can make an informed decision by seeing which one's actually going to provide more value. And then after we cover all of this, very quickly, we'll look at the retirement income illustrations you had requested. With that said, let's get on into it and have some fun. So what we've got first are the two options. Let's start on the left with option A. So what we've got here, option A, funding the policy aggressively upfront. So this is the illustration. I included the detailed illustrations from Guardian as well, but here's what we've got going on. So you are in policy year 4 right now. This ends February of 2024, or that's when policy year 5 begins. So with this, we've got the additional $200,000 PUA payment going in this year. This will bring your total funding up to just over $800,000 to date since starting the policy. So nice work aggressively funding the policy. Your cash value, this will be February of this year, will be just over $791,000. Death benefit still at $6 million. Then we've got the next 2 years, years 5 and 6, where you're funding it at $250,000. So over the next less than 2.5 years, it's 2 years and 3 months really, you're getting $750,000 into the policy. So this is aggressive funding. Why this is boxed here, these 250 payments, is because these are the 2 years when money is going in. You'll also be borrowing it out. I'm going to pull up an illustration that shows that in a little bit. But you'll be taking out loans in this example to pay for the home. I know also, initially, your plan is to use that excess $400K you have just to put a down payment on the home right now or pay really for the first installment. So if the home cost is $1.2 million, that will require financing from the policy in this example of another $800K. And you'll see that in loans coming out with this specific option in just a minute or two. So just to recap what we had on the whiteboard, you're aggressively funding it up front. And while you are aggressively funding it, you're also taking out policy loans to pay for the new home. Then down here, years 7 and 8, we've got just $20,000. At this point in time, we're assuming you pay just the minimum premium. And the reason why is because you would be redirecting cash flow to pay off the policy loan. So instead of aggressively adding money into PUAs, you're paying off the loan. And then years 9 and 10, you begin to aggressively fund the policy again. Total out of pocket, and this goes back to day one, over $1.8 million into the policy. Then you've got your cash value buildup, just continuing to compound along with the death benefit as well. Okay, so that's option A. Then we've got option B. So with option B, we're assuming you pay nothing right now. So what I mean when I say that, year 4, instead of adding $200,000, you add 0. Your total out of pocket thus far, $600,000 and change, $200K less than option A because you're not adding another $200K this year. Then years 5 and 6, you're funding just the minimum premium, $20K per year. Compared to the option on the left, you're aggressively funding. Why this one has only $20K is because what you would be doing is taking the cash you would normally shove into the policy and throw it right at your new home. Then, once the new home is paid for, we begin making up for lost time, get the payments of $250 in each year, and then in year 11, get the last $200K in, which we did this year. So option to the left, you've got the 4 payments of $250, the one of $200 initially. Basically, we just deferred all of that funding until the home is paid for. So what we want to look at here is what's the difference in cash value. So here we go, cash value difference. This displays how much less you have in cash value with option B directly compared to option A. So there's a big difference, especially considering the out-of-pocket is exactly the same. So even when you get all of the money in, here's really where it's going to be the closest at year 11, $136,000, almost $137,000 difference. And this is with your existing policy, interest rate assumptions and everything are identical with this. So a big difference. And why there's such a difference is by you getting the money in up front, what that does is it just gets to work for you. It's compounding earlier rather than later. And with that dollar amount going in, it's a big difference there. So here we've got the difference just in pure cash value. However, what we do want to consider is the loan interest. Because with this option, you're paying loan interest. And to be fair, I'd want to know exactly how much loan interest I'm paying. This way I can factor that into the cash value difference. So let's look at a side-by-side comparison. So to the left, this is option A. And how we can see it is as follows. You've got the funding aggressively for years, for the next 3 years, then scaling down to the minimum premium, then scaling it back up. This is exactly what we just looked at. What we have to the right is as follows. Policy loans, next 2 years, $400K. There's the 2 loans. Here's the annual interest that will be due each year, 1, 2, 3 years. And then you're aggressively paying off the loan principal. Here's the total interest that is paid to the insurance company in this specific option. Where we got this data from is if you go to this tab over here, Delay PUA's loans. So this is just our loan workbook. Here we go. So you've got the policy values on the left, LTV at 95% of cash value. That represents the maximum loan you can take against a policy. This column here, highlighted in yellow. But we've got our 2 400K loans coming out. To the right, you've got the annual interest payment. There we go. That's how much I'm paying to the insurance company. Now, when you take loans, you would see your available cash value to borrow look more consistent with this column. Whereas the illustration we looked at in the second tab, we saw the values, the cash value death benefit never change. And the reason why I did that is because you're still earning dividends and interest on the full cash value. The death benefit is also collateralized when you take those loans out. However, you're still earning interest on everything, specifically dividends and the guaranteed rate. But this loan workbook does display the actual impact on cash value and the death benefit drop. Let me know if you have any questions on that. Going back to what we were just looking at here. So you've got policy loan, then the loan principal payment, interest paid to the insurance company on an annual basis, and then the total interest paid to the. So let's compare it to option B. So here we go. Option B on the right. There's your funding. Nothing this year, then just the premium, then scaling it back up. And the reason why is because you'll be taking cash that normally would go into the policy and instead just throwing it directly at the home. So let's look at the difference here in actual cash value performance. So first, we've got this column. This is exactly what we looked at on tab 1. So for example, year 11, you've got $136,000 less with option B compared to option A, and you'll see that on tab 1. The difference now is this. Let me get my big head out of the way. So what this is factoring in, so we see cash value difference with loan interest. With this option on the left, where you're using policy loans, what we do need to account for is the fact that you've paid $90,000 in loan interest to the insurance company. So we want to deduct that $90K from the cash value difference. So when we hit the same point in time, year 11, yes, option A gives you $136,000 more in cash value, but you also paid another $90,000 in loan interest. That was money out of your pocket. So the true difference here, this is at year 11, when you're 58, $46,000. So that's how much more you have in cash value by going with option A if we keep everything exactly the same. Because with option A, you've got the 2 $400,000 loans. At this same point in time, you'd be taking those $400K payments and throwing them at the home. So we get the policy funding at a minimum here, and you'd be dishing out that $400K just to pay for your home in cash. Then, with option A, here we just scaled the funding down to the minimum and repaid the 2 $400K payments, the policy loan payments. So with keeping everything consistent, what we've got is a clear winner with option A, especially as time passes. The reason why, you got the money in sooner over here, so it's just going to begin compounding earlier. Your policy is already 4 years old, so you're beyond the early years. If you were trying to do this from day one, meaning start a policy and pay for a home right out of the gates, the numbers would not look as favorable as they are right now because you'd have the negative years with the life insurance policy. You're beyond that already. So that's where the numbers are more and more attractive in this particular case. So the winner is option A. What I also put together is a more conservative scenario. So the next tab, what we've got here, is the exact same thing, but showing what does it look like if I fund the policy aggressively, take out loans aggressively, pay interest every year, but I don't repay it aggressively. What if I just pay it at $100K per year instead of $400,000 per year? What that will result in is you paying more loan interest annually. So in this scenario, if you pay a little bit more than $225,000 in loan interest to the insurance company, how does that work? Like, which scenario is better? Here we see option B. There's a period of time where you actually walk away positive. And again, why we're positive here, just to hit on this point, let's look at year 11 because we've looked at that. So year 11, 2.153 compared to 2.290, that again is with option A. You've got how much more in cash value? $136,000 with option A. Now, if we factor in the extra 210 or 209 you've paid in loan interest with option A, now all of a sudden, option B is more favorable by $72,000. So if you took your time repaying that policy loan and pay more loan interest to the insurance company, that can cause a situation like this where you see option B, which would be paying for the home in cash, would be a bit more effective or a bit more efficient. With that said, long term, option A is still going to catch up just because of the compounding by getting that money in early. That really plays into your favor. And based on our discussion and your approach to debt, just wanting to always wipe it out as quickly as possible, you might look at this and say, hey, this is probably a bit unrealistic. I'm going to do it faster, even if I have to kick the funding down over here for a little bit, which I would recommend paying the loan down first, then aggressively funding PUAs. If you do that, it's going to look more like the first loan tab we looked at, which makes option A the clear winner by quite a bit, right, from start to finish. And when I look at this by age 70 or 75, when I'm looking to take income from the policy, I mean, you're six figures as far as the difference is in cash value. So with all of that said, option A is the winner in this particular case. Let me know if you have any questions at all while reviewing these numbers or this video. Let's wrap it up with the income illustrations. So tab 4, income illustration. We've got income starting at age 62, 65, and 70. Here we go. Starting with age 62. I've got option A for all the funding scenarios. So funding goes in. Let it ride till age 62. And here I illustrated $125,000 per year coming out of the policy. So what I like to look at here is when we look at your total out of pocket, it's $1.8 million in change. When you start to pull money out, what I like to look at first is when do I get all of my principal back? So it's just about 75. You got back your $1.8 million in change. You still have $2.4 million in cash value. And if you die, there's a death benefit of just about $3.6 million that's paid income tax free. If we look at it long term and you said, all right, what if I die at 90 years old? Like, what's going on here? At 90, you've pulled out, here you've got about 1.8 million, the 1.779. That's the difference there. So this means you got out your original 1.8 plus another 1.779 in distributions, and you've got 1.4 left in cash value and a death benefit of almost 2 million. I ran the income up until 95. We can make it go longer and adjust this if you'd like, but I think you know what I'm doing here. Option to the right, same thing, but deferring income to 65 and pulling out more as a result, 150 per year. Same thing, when do we get our 1.845 back? By about age 76. And that's how much you still have left in the policy. And then on top of the 1.84, you get another $2.6 million in income. And this is not a MEC or anything like that. As long as we prevent a policy lapse or a MEC, you can get this all out tax-free, which is sweet. And then to the far right, we've got income starting at age 70. Same thing. The more you defer it, the longer you defer it, the more money you will be able to take out on an annual basis. But what I'll say to kind of wrap this up is when it comes to taking income from a policy, some people do like the idea of doing what you see up on the screen here, where you just take a level amount of income every year. However, what you could also do is adjust the dollar amount each year. Remember that when we take money from the policy, it's tax-free, as long as we don't mess it up or anything like that, which we'll make sure doesn't happen. But if you've got other income sources and you said, okay, during these years, I'd like to take some additional income. So I've got 200 grand in income from my other retirement accounts and such. I'd like another 50 grand or another 150 grand this year. You can dip into it and supplement income at your discretion, which is really nice. So with all that said, let me know if anything does not make sense. Let me know if this helps. Let me know if you'd like to see any revisions to the model. We can definitely look at some different adjustments. And if you'd like to play around with a loan workbook, we can do that too. So you can really narrow down exactly what you feel is realistic when using the policy to pay for the home, and then make a decision based on really what you're most comfortable with. Thank you again so much for your time last week. I will talk to you soon. Bye for now.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.